So recently I just made a stock portfolio update video where I revealed that the value of that portfolio just went over £30,000. And whilst that's all great, there isn't actually that much value in that video, which actually shows you how I got to that point in the first place. So in today's video, what I'm actually going to do is talk through a couple of the main things that I made sure I put in place that really did help me go from zero to a £30,000 stock portfolio in just over 3 years. But of course, just a quick introduction to myself for those that haven't met me already. My name is Christos Fellas. I am an entrepreneur and investor, and on this YouTube channel I talk all things personal finance. So if any of those things interest you, then consider subscribing down below. But other than that, let's jump straight into it. Alright, just starting off, let's get the most obvious thing out the way at the start, and that is of course to get to a £30,000 stock portfolio, I obviously had to invest quite a lot of money at the start. But the thing that has helped me get there a lot quicker than I anticipated is my consistency of investment throughout that 3.5 year period. Basically what I did was I looked at my incomings, my outgoings, and what I did from there is I picked an amount that I knew that I could invest every single month, that I didn't have to worry about spending it. And I did that for 3.5 years, and I'm still doing that right now with absolutely no fail at all. Just going back to day one, I think the first amount that I started off with was £400 every single month, and as time has gone on, my side hustles have increased, my salary with my job at the time increased, I started to up that amount, and right now I'm currently investing anywhere between £1,000 to £1,500 every single month. However, like I always mention on this channel, the amount that you're investing is completely irrelevant. It is all to do with your consistency and the time that you spend in the market, because basically what is going to happen is if you are making consistent investments, sometimes you're going to be able to buy the stock when it's going up, and sometimes you're going to be able to buy the stock when it's going down. This is called dollar cost averaging, and over a long period of time your gains are going to be much more consistent, and there's going to be a much higher chance of you actually making money in the stock market. The second thing that I want to talk about, and this is going all the way back to day one, and that is when I made my first investments, I stuck to stocks where I actually knew about the company and I used the products on a daily basis. I didn't know how to do any stock analysis, I didn't know what any of the terms meant, but I knew I wanted to get started, and I knew that if I was to pick a massive company that I knew was going to be around in at least 10 years from now, it was going to be a lot harder for me to go wrong than if I was to go and pick an unknown penny stock, one that has got huge potential that you've maybe read about on Twitter or something like that. I thought it was much safer to go for a bigger company, and this has paid off massively in the long run. Just for reference, the two companies, if I didn't mention it already, was Apple and Facebook. These were my first two ever stock investments, and of course these are absolutely gigantic companies, and I use their products on a daily basis, and I will continue to use their products for the foreseeable future. Alright, so the third thing that I did, and this is probably the biggest turning point in my investing career and journey so far, and that was when the markets were down and there was a lot of fear in the markets. That's when I decided to go all in, and it paid off really, really well. And basically the time that I'm referring to here, we all know it extremely well. It was March 2020 when the coronavirus first hit our TV screens, or hit the entire world in fact, and the markets went into complete meltdown. But one thing that always stayed in my head during this time was a quote from the most successful investor in the world, Warren Buffett, and that basically read, "Be fearful when others are greedy, be greedy when others are fearful." And like I said, during March of 2020, all you could see on the news was, I don't know how the S&P 500 is going to survive this crash. They were having to stop trading at points. People were so scared about their investments. People were selling off everything. And to me, using that quote as well at the same time, I saw this as a massive opportunity. And I'm just going to throw up a chart of the index fund that I piled most of my money into. As you can see on this chart, there was a massive dip during March, April time of 2020, and then look at the progress it has made since. Guys, the stock market has been around for hundreds of years, and it has a proven track record of always trending upwards in the long run. For the S&P 500 to go down to a value of 0, that would mean America would have to literally be wiped off the map, and we all know that's not going to happen. So I took my gut instinct and I took what the most successful investor in the world had to say, and I went and put all of my money into an S&P 500 index fund when it was at its lowest point, and of course it is now paid off. The next thing that I've done is something that I've actively thought about during the past 3.5 years of my investing journey, and that is making sure that my portfolio was well diversified. Now, I've mentioned already that I've invested into an S&P 500 index fund. That automatically makes you very, very diverse in the stock market. But one thing that I like to do was a strategy that I kind of made up myself really, and that was to make sure that 50% of my portfolio was going into index funds. So they were low cost and they were very, very low risk. I didn't have to think about them too much. 25% of my portfolio were going into value stocks. So these are like the big companies that I'm talking about, like Coca-Cola, like Facebook, like Apple. I know Facebook is typically considered as a growth stock, but what I'm talking about is massive, large market cap companies that I know that are going to be around for the long time. And then I took the other 25%, and that's where I went and put it into the more riskier investments. So one company that I've talked a lot about on this channel is Tattoo Chef. This is a really, really small company and a really, really new company. This could go either way, but the risk reward potential is a lot higher than typically investing into a Coca-Cola stock. But that is absolutely fine because I know that I'm covered. 75% of my investments are typically known as lower risk ones. And then with that 25% that I've got to go for my growth stocks, then I can have a little bit more fun and be a little bit more riskier. Now, the next thing that I want to talk about is probably a little bit specific to the UK, but there are definitely options in the US for you to do this as well. And that is making sure that most of your investments are put into a tax-free ISA or some kind of wrapper, so you don't have to pay any tax on the capital gains that you make. Now, in the UK, like I mentioned, we have a thing called a stocks and shares ISA where you can actually invest up to £20,000 every year and not have to pay any capital gains on any investments that you make, and any dividend payments that you receive is going to be tax-free as well. This is extremely helpful, especially when you are starting to grow a portfolio over time, because of course, if you're going to receive dividend payments, that could potentially make you liable to pay tax on them. I had this just last month where I got £100 in dividend payments from my different index funds and my Coca-Cola stock, and I was able to take that full £100 and actually buy some more stocks with that. Whereas if this wasn't in a tax-free ISA, I was going to probably have to pay tax on those dividends that were being paid to me. So it's extremely important where there are tax breaks that are available to you to take as much advantage of them as possible. But just to summarize, the 5 main things that I thought were absolutely key to me growing a portfolio up to £30,000 worth of value were: number 1, consistent deposits, like I mentioned. Number 2, making sure you understand the investments that you're actually making. Number 3, blocking out the noise from the media and investing for the long term. Be fearful when others are greedy, be greedy when others are fearful. Number 4, making sure that your portfolio is well diverse across different low and high risk stocks. And then number 5 is making sure that you keep your investments in the most tax efficient way possible. But other than that, I hope you enjoyed this video and you got some value from it. If you haven't already, make sure you go down and click the link in my description down below and sign up for FreeTrade, where if you actually deposit £1, you will actually get a free share. If you are looking to start your investment journey, this is a great platform to start with. Other than that, comment on this video, anything that you want to say. If you have any questions or anything like that, like it if you got some value, and of course I will see you guys in the next one. Take care.